A lot of you ask me about macro. What do I think about macro in general? How do I apply it in my own investment strategy? I think macro is amazing and it's a very useful and powerful tool. But I believe most investors, especially long-term fundamental kind of investors, they use macros the wrong way. They get distracted by it. They try to get in and out of stocks because of how macro is looking or what the Fed's gonna do. And I think this is a massive, massive distraction. Is gonna hurt your returns very, very much. And a lot of people are too obsessed over macro, especially since 2021. Because if you look at most of the YouTube videos before 2021, they were mostly around Warren Buffett, what kind of stocks did Warren Buffett buy, some kind of fundamentals, value investing, long-term investing. Well, it's not like that anymore. You still see videos like that on YouTube, but most of the videos are anything around fear. Like, for example, the BRICS is taking over, the dollar is gonna crash, the end of the world, the market's going down 50%, or we're gonna have a rally to something like 6,000. You always have these kind of things that include any macros. They get most of the attention, but they are very hard to profit from them. And in this video, I'm gonna show you 3 reasons why you should not be too obsessed over macro, and I'm gonna tell you how I use it in my own strategy. Now, the first reason why you should not be too obsessed over macro, I talked about it, is it's too hard to profit from it. And the proof of that is just the returns of the hedge funds versus the S&P 500 since 2018. As you could see, the hedge funds have massively underperformed the S&P even in 2018. Whenever we had the Fed hiking rates, you had a lot of macro factors. Most of the hedge funds, they use a lot of macro to get in and out of stocks, hold a larger cash position, all these kind of things. Well, they should have been outperforming the S&P in 2018, and they actually did outperform it, but there's a downside. And as you can see in this chart, the S&P has pretty much crushed hedge funds. It has crushed those macro kind of investing. Most of macro investors, I mean, they have not been doing well over the last decade, but holding companies for the very long term without going in and out, without worrying too much about the Fed and a lot of other things, although you have to pay attention to them. I mean, it has hurt investors over the last 10 years if you were just looking for a reason to sell or to get out of stocks just because of macro. So it's very hard to profit from it. Now, the second reason why it's actually kind of also hard to profit from it is that it could already be priced in. Okay, now if you look at the chart of the S&P 500, every single macro indicator was showing that the market should crash to around maybe 3,000 or 3,200. There's all kind of indicators. A recession is gonna come. The stock market is gonna crash. All these kind of things. Also, I expected the market to go down much, much more. But you could see what happens is October. We bottomed when no one expected the market to bottom, and we have rallied up to 4,500. This is pretty much unheard of when people are calling for a recession, and every single macro indicator is telling you the market should be lower, yet the market has gone up, has squeezed out a lot of shorts. A lot of people that were holding 100% cash because they were waiting for the crash actually did get hurt very, very much. And this is because of expectations. Information alone is not going to give you any kind of edge. For example, let's assume you know that the Fed's going to hike to 5.5 or 5 3/4, but everyone else knows that. And if everyone is expecting that, this might actually be priced in within the expectations. This is what happened in October. Everyone was pretty much calling for a stock market crash. Everyone was expecting a recession. Over 100%, they were expecting a recession. Well, this would leave a large margin for the opposite to actually happen, and this is what happened. We didn't have a recession. I mean, maybe we did in the first 2 quarters, negative GDP, but we didn't have anything crazy. The market did not really crash as much as it should because everyone was expecting them. So you don't only have to be right on the information, but you also have to be right on the sentiment and how investors actually perceive this information, which is why it's very, very hard to profit from macro investing alone without buying any kind of stocks because of fundamentals or any kind of fundamentals. If you just go in macro, in my opinion, it's extremely, extremely hard. I mean, to actually profit from it. Maybe this is one of the reasons why, Warren Buffett, Charlie Munger, and all these guys most of them are fundamental investors. You still have popular macro investors, but even that scam. They actually use some fundamentals in the process, but it can really hurt you very much, and it could actually cause you to get out at the wrong time. And the final reason why you should not be too obsessed over macro, and this is the most important one, this is the biggest mistake that most investors make with macro. They even join my group and they tell me these kind of things, and this is that it makes you short-term oriented. This is an amazing chart, and it actually shows you the $10,000 gross invested in the S&P index from 1980 to March 2020. All right. Now, if you stay invested all days in the markets, the good days, the bad days, all the time, you just stay invested, you're going to have around $700,000 by March 2020. Pretty amazing. Now, if you missed the 5 best days in the market, you're only going to have $432,000. If you miss the best 10 days in the market, you're only going to have 313,000. If you miss the best 30 days, you're only going to have 115. If you miss the best 50 days, you're only going to have 48,000. This is a massive, massive difference. There's all these kind of reasons of why you should be 100% cash, on why you should get out. You have seen a lot of videos with thumbnails saying get out of stocks, sell stocks, don't buy stocks, like all stocks are created equal, which is actually not true. And this is something I always talk about. If you look at the 2007 to 2009 financial crisis, it was pretty bad. But even in the financial crisis, you had stocks that outperformed. You had AutoZone was up 22%, Ross Stores was up 10%, Walmart was up 7.4%, Advance Auto Parts, which is now a disaster, it was up 4.4%. Even McDonald's was pretty much flat. Netflix was up 68%. So even in the financial crisis, if you just said sell stocks, not all stocks are created equal. There's always outliers, there's always undervalued names, recession-proof kind of names. There's a lot of positioning, a lot of things you could do in your portfolio if you're so worried about the recession. But we always have stocks that outperform. Even in 2022, we had a pretty big decline, but even then you were seeing videos of sell stocks, don't own any stocks. Yet Occidental Petroleum is up 119%. ExxonMobil was up 87%. Valero was actually up something like 75%. We have in my own investment group a lot of coal investors. They invest in coal stocks. A lot of the stocks that they own, they were up between 100 to 150% in 2022. Most of the oil guys, they were up 50 to 60% on the year. So even in 2022, you had stocks that did well. And this is, I believe, where most people should focus their energy in kind of finding those stocks that will do well and finding stocks that are undervalued, not just sell all stocks, not treat all stocks the same way. This is something I hate so much. I hate whenever someone tell me I'm getting out of the market because the market is going to crash. Well, are all stocks rated equal? Do all stocks move together? Maybe, but not all of them. There's always something that's underperforming. There's always some kind of an outlier. Even the kind of solar stocks in 2022, Enphase, it was making new all-time highs, new 52-week highs, while a lot of other stocks were actually going down. So there's always these kind of stocks that will do well no matter what, which is why you have to be careful in saying, sell stocks or I'm not buying stocks because of something crazy. Now, the way I implement macro in my own strategy, the way I do it is whenever I'm buying a stock, especially if it's cyclical, if I see the Fed's about to start hiking rates, I see a potential slowdown, I have to factor this in my valuation model. But if I have a stock that has a lot of debt, I have to say, okay, is it fixed or is it variable? If interest rates go from 3% to 5%, what is the interest expense going to be? How is this going to affect the EPS? Can they potentially miss on EPS? This is the kind of things I try to look for and I try to use macro for in my portfolio, but I never ever told anyone, even in 2022, whenever I was making macro videos, I never told anyone to be 100% cash. I never told anyone to get out of the market because the market is going to crash. I always keep a cash position. What I do in a market crash, even in 2022, I always told people that I always start a small position in something that's undervalued. If it gets even more undervalued, I add more on the way down, and then I can establish a full position at much lower cost basis. And I would love the stock to go down because I want to buy more of it at much lower prices. So this is the way I implement macro in my strategy. This is how I believe most investors get distracted. They say, oh, the market is going to crash, so I'm going to get out of the market. Well, what if this doesn't happen? But what if the stock that you got out of goes up like 50% while the market was going down? This is possible, which is why I believe it's best to treat each individual stock on its own and use macro to see how it could potentially affect the earnings and the balance sheet of this company. And this is what I try to do here with my own investment strategy. And this is what I do. No financial advice, of course. Thank you for watching the video. I hope you enjoyed it as usual. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.